Hello students and welcome to the lecture. So students, as we know that we are covering the financial system and basically in the previous lecture we had done with the stock market indexes. I hope that you have revised the previous lectures in the well enough manner before you have come for this lecture. As many times I have told you that is for your own benefit. So if you are doing this on the regular basis, that will be beneficial for you. Okay. So basically in this lecture we are going to start with another important topic which is known as the foreign investments. Okay, basically foreign investment is you can say the relation of the foreign trade, okay, but not related about the regular import export. Okay, so remember the foreign investment is in the relation with the foreign trade, but it's not the import export regularity. Okay, it is, you can say, somewhat different. All right. When we talk about the foreign investments, then foreign investments are basically of the three types, like you can see here. Okay, this is also the index, and you can say these are the topics we are going to cover. Like we will start with the foreign direct investments. Okay, foreign institutional investments. All right, foreign portfolio investments. So you can say these are the three types of foreign investments that we are going to cover. Okay, so basically first you can say we are going to talk about the foreign direct investments. Okay, second is the foreign institutional investment, and the third is the foreign portfolio investments. Okay, so let's start with the foreign direct investment. First we will see the introduction to the FDI. Remember, the foreign direct investment is often known as the FDI. Okay, so the introduction part starts with foreign direct investments, and the FDI refers to investments made by a company or an individual in one country in business stress in another country, in the form of either establishing business operations or acquiring business assets in the other country. Okay, such as ownership or controlling interest in a foreign company, real estate or production facilities. FDI is distinguished from portfolio investments, which is a passive investments in the securities of foreign companies. Okay, so now it's a time of, you can say, it's a time to understand the things in the proper manner. Like whenever we talk about the foreign direct investment. Okay, so what is the general meaning of the FDI is hidden in its name itself. Like if you look at here, it means foreign. Foreign means that it is from the outsider. Okay, or you can say that this is the foreign entity. All right, second word which you could see here is the direct. Direct means that by entity itself. Okay, and the investment means liquidity. Okay, so now just look at this picture. Foreign means the outsider, direct means by entity itself, and investment means liquidity. It means that suppose if there is a country A, there is a country B. All right, so when the country A having some company, suppose the XYZ, the XYZ is a company of country A. It means that the XYZ had registered its headquarters in the country A. All right, so whenever we talk about the term globalization, so there is a very famous you can say quote which is attributed to the globalization, which means that you can say the countries without borders, right? So basically the globalization empowers the countries to do trade with each other, or even the companies which are belong to one country could start and establish the business in other country if the country is in the good terms. What do you mean by the good terms? Suppose if A and B are the enemies, so what do you think? Will X by Z will be able to establish the business in B? No, never, right? But here what is happening, that both the countries are in the good terms. Okay, so in this you can say particular series of the foreign investments, we will only consider the countries as in the good terms. Okay, because the investments could only be made if the countries are in the good terms. All right, so now come back to the topic. XYZ wants to expand the business, okay, and they had found that the country B having the potential through which they could expand their business. All right, so basically what could happen, that the XYZ will get several you can say options, like either they could you can say invest in the stock market of country B. Okay, you can say either they could establish the partnership, all right, with some company of B. And the third option is the direct investment. It means that XYZ will directly invest in country B and establish XYZ 2. Okay, it means that the XYZ having its headquarter in A, but it's having its unit, maybe the you can say the manufacturing plant or the real estate or the production facilities outside of their country. Okay, that is known as the foreign direct investment. Why? Because the XYZ actively investing. Actively investing. It means that instead of going through the passive channels, they are directly providing the money, or you can say directly investing their resources into some other country. So here we have you can say got two new words. Active investing and passive investing. Okay, so what do you mean by active investing and the passive investing? Okay, so basically when we talk about the active investing, it means that direct investments. Okay, when we talk about the passive investing, it means that indirect investments. For example, suppose this is the new building, or you can say newly constructed building. All right, so basically you are here. Okay, so you want that you must own some flat in this newly constructed building, and the owing flat will be your investment. Why? Because you will invest some money there, right? Then only you will be eligible to buy a flat. Okay, so if we go with the active investing, or you can say direct investment, so what will happen? You will directly establish the contact with the building owner, and what will you do? You will buy a flat. Okay, all the money will be directly provided by you, right? That is called the direct investment. But in the passive investments, suppose the flat costing is rupees 10 lakh, 20 lakhs, whatsoever. All right, so what you have done, that you have go into the money pooling scheme. It means that suppose some group of individuals or some organizations are buying the flat in them. Okay, so what you did, you provide the money to them, and through their through your contribution, they had bought a flat there. Okay, it means that the flat which have been bought by the money pooling entities, on those flat you having the share because you had provided the money, but you haven't directly invested. Okay, you have invested through some channel. So that is known as the passive investing, because indirectly you are investing. Suppose if there is a company ABC, so the flats which will be you can say buy by the ABC will have the ownership in reference to the ABC, but the ABC has got the money from you, so indirectly you will be the owner. Okay, so that's are the two options. So why people go to the passive investing? Because the passive investing is having the low risk. While the active investing is having the high risk. Okay. Now, why? Because if we talk about the active investing, so suppose the flat cost rupees 10 lakh. So when you directly go to the building owner, it means that you are paying the entire amount. Okay. So if anything adversely happen, it means that your investments will be harmed directly. Okay. But when we go to the money pooling, or you can say through the indirect channel, so maybe you are not required to pay the entire amount. You are only required to pay some percentage in which you will get the some portion of the ownership. So if anything adversely happen, you are the not you can say only person who will be affected. It means that the others will be also affected. So the risk will be distributed. Whereas in the active investment, the entire risk will be on you. Okay. So this is the thing. So when we talk about the FDI, then FDI is much more risky in comparison with FII and the FPI. Why? Because the FPI and FII are some kind of, you can say, contributing share schemes. What do you mean by this? We will explain this in the upcoming series. But till then, just revise that FDI means the active investment, and all of these are basically the passive investments. It means that here you are directly investing your money. Anything adversely happen, your money will be harmed directly. In this, you are indirectly or through back channels investing your money. So if anything happen adversely, only the small portion of your money will be affected. Okay, I hope that you have got an idea about the active investing, passive investings, and then the FDI itself. Like how does the FDI works? Okay, please remember this thing: foreign direct investment, outsider by entity itself, liquidity. Okay, and basically FDI is like taking the ownership and the controlling, and it could be done by two ways. Okay, like you can say directly open or acquiring domestic entity. So what do you mean by this? Let's understand. So basically, if we go back to the example which we had taken in the first sense, like this is country A, this is country B. XYZ belongs to country A. Okay, or you can say it's a company of country A, XYZ. Okay, so XYZ wants to invest in the country B. There are two ways. First is direct investments. Second is acquiring. Okay, just recorrect it. Establishing new venture and acquiring domestic venture. Okay, so if we go by the first one, all right, XYZ. So suppose the XYZ now wants to open the entity in country B. Okay, there are two ways. The first way is establishing new venture. Second way is acquiring domestic venture. So suppose the XYZ will examine the factors and the economic conditions of country B. Like how does the country B is performing so far. Through this, they have got an idea that whether there is any entity existed in country B which could be helpful in their business. Okay. If they found that there is no entity existed in country B which will be beneficial for their business plan, so what will happen? That they will establish the new entity called XYZ2. Okay. So XYZ will be the parent company, XYZ2 will be the subsidiary. Okay, this is the first case. Why? Because if we have taken an example of some, you can say multinational companies like Amazon. Okay. So Amazon is having its headquarters in the USA, United States of America, right? But they having their headquarters, or you can say their regional offices in India also, which are known as, okay, just rub it, which are known as Amazon India. Okay. So main Amazon is in USA. Amazon India is the subsidiary. So parent company is Amazon India is a subsidiary. So same thing will be happen here. XYZ is a parent company, XYZ2 is a subsidiary. Got it? But in the second case, suppose if the XYZ finds out that there is a one company which is ABC, and this company is eligible to fulfill the business expansion needs of the XYZ. So what will happen? Instead of establishing their own venture, then try to capture the market, then try to acquire the consumer base, what they will do? They will directly acquire the ABC, which has already established, which having the consumer base, okay, which having the market capitalization. Okay, so there are two ways for the FDI: establishing new venture or acquiring domestic venture. And the third way is also, which is you can say very least active, which is known as the partnership venture. Okay, partnership venture means, suppose instead of acquiring the ABC, the XYZ has partnership with the ABC. All right, this is generally done because maybe when some company comes from outside, this company may not have the experience required in that particular market. So for these conditions, they taken the help of another ones. Now, FDI policies, like what are the policies for FDI in India? So first is the Department for Promotion of Industries and Internal Trade. This is very, very important. The DPIIT under the Ministry of Commerce and Industry is the primary agency responsible for formulating and implementing the FDI policy in India. Okay, like many times I have seen the students who consider there's the Ministry of Finance is responsible for the, you can say, the foreign direct investments and the foreign investments. Many times I have seen students. Okay, but remember, the Ministry of Finance generally has nothing to do with the foreign policies, or not foreign policies, foreign investment policies. Okay, because Ministry of Finance is basically designed to look after the financial matters of India. Okay, but the foreign investments comes under the Ministry of Commerce and Industry. Okay, remember, Ministry of Commerce and Industry, and the department name is Department for Promotion of Industries and Internal Trade. Okay, so keep these two things in your mind. The first is Ministry of Commerce is the one which having the policies leading with the foreign investments, not the Ministry of Finance. Second, the particular department of Ministry of Commerce Industries, which we call as a Department for Promotion of Industries and the Internal Trade, is the one which look after the policies. It plays a pivotal role in promoting both domestic and the foreign investments, facilitating business growth and ensuring the conducive environment for the economic development. Okay, like you can say promotion of industries. It having two words: promotion of industries, second is internal trade. All right. So when we go with the first one, promotion of industries, it means that what? What does it mean? It means that it is comprised both domestic and foreign investments. Okay. But when we go with the internal trade, it is mainly concentrated with the domestic trade and investments. Okay, these are the two things. Got it? So basically, students, in this lecture, what we have seen, we have taken the overview of the FDI through the flow chart. We have seen the, you can say, two things like the actively and the passively. So I want you to know these things in your, you can say, to keep this thing in your mind, because in this upcoming course, or you can say in the upcoming slides also, we will use them things. Okay, so if you forget them, if you not revise them, then that will be a little bit hard for you to recall the things in your mind for the long duration. Thereafter, what we have the FDI policies undergoes regular review and revision to align with India's economic goals, global trends, and changing investment scenarios. Okay, like basically I had told you, world economy also is dynamic. It means that months after months, years after years, and even a certain period of time, the things was changed. Okay, that's why the FDI policies also need to be reviewed and revised to align with the India's economic goals, global trends, and changing investment scenarios. Because if we do not make changes in our policies, so what will happen? After some time, we will be outdated. Okay, and you can say, in the worst case scenario, we will be isolated. Why? Because the global trends will be totally different in reference to us if we are not, you can say, upgrading ourselves. This process ensures that the policy remains dynamic and responsive to emerging opportunities and challenges, enhancing its effectiveness in attracting foreign capital. Okay, like if you make the policies as per the global requirements, so what will happen? The global players will attract you to your country and the foreign capital will start inflow in your country. So students, basically in this lecture, we have seen several things about it. Okay, in the next lecture, we will start from here. Till then, just revise all the facts and figures we have discussed in this lecture. Be ready for the another lecture. With this note, let's end this lecture. And what do we say? We say thank you.